Welcome back to the Loonie Hour, episode 5. We got, as always, we got Rich Diaz here with Acorn Macro Consulting, macro research for institutional investors, hedge funds, etc. Extremely smart guy. And of course, we've got everyone's favorite boomer, as always, Keith Dicker, 30 years with IceCap, or 30 years managing money professionally, the founder and CEO here at IceCap Asset Management. Legend of the show. Keith, welcome back.
Hey guys, good morning. Good morning to Steve, right? You're up early compared to what your normal hours are?
Yeah, it's just 6 a.m. here in Maui. So living the good life.
And what are the temperatures? What are the temperatures for you, Steve?
Oh, it's like 30 degrees here. I'm hiding inside. Rich
nice to see you. Morning,
just woke
guys.
up
Nice
too.
to see you guys. I just woke up.
It's 3 p.m. there.
No. It's nice to see you guys. Morning.
So guys, I'm based in Halifax here, and we're getting some frost in the morning now on the cars and the leaves and stuff. But it's just beautiful autumn weather. So we're it's a bit cooler than where Steve is enjoying his holiday, but it is quite nice out here right now in the Maritimes. Let's get going, guys. Let's do episode number 5.
Episode 5. Yeah, I just want to make a little bit of context here. We are filming and recording this on November the 11th, Remembrance Day. So I want to give a shout out to all the vets out there. Lest we forget, as good Canadian folks that we are, we appreciate your service. But as usual, we don't want to beat a dead horse here. We will talk a little bit on some of the headline inflationary data coming out, because it just came out yesterday and we're recording this here today. But, US, we're going to talk basically about, touch on a little bit on the inflation story here. But we kind of want to be, as Keith called it, an equal opportunist show. And we want to touch on, the merits or at least the counter argument for deflation, because everybody's sort of on one side of the trade right now, which is inflation. But we do want to talk on, what is the outcome with scenarios and how do, Canadian investors prepare for a possible deflationary shock, because that's always a possibility. But first and foremost, want to touch on the U.S. CPI inflation coming in at 6.2% year over year. Obviously, again, I think that the economists and sort of the mainstream continues to sort of miss this. We've been told it's going to be transitory, and it seems like it's no longer transitory. And there's been that sort of funny meme on Twitter where it's like, tell people it's inflation is transitory, then tell them it's going to be here for a little bit longer, and then tell them inflation is good for you. And I feel like we're at that inflation is good for you story because I saw a couple of headline articles coming out of that. Rich, I don't know, do you have any comments, at least from your data perspective there on what you're seeing from the inflationary side, not just in the US, but elsewhere?
Yeah. So, I think it's important to concede. So I think you were mentioning that, just to kind of I want to just touch on just those different stages. So we were told that there was going to be no inflation, and then we were being told there was a little bit, but it's not as bad as you think. And then we were told, stage 3 is that inflation is transitory. And as you pointed out, we're about to be fed this basically spoonful of sugar that inflation is actually good for us. I think it's important to concede that some of the inflation is transitory. We've mentioned it on this podcast before. Maybe we'll get into beef prices, things that are acutely tied to supply chain issues and stuff like that. But I think for me, what the number that I spend the most of my time looking at, and I think I've gotten this number wrong in this podcast, but I'll get it right today, which is the shelter component, both in Canada and the US. In Europe, they calculate CPI a bit different, but in the US, I know it's about 42% of core CPI, and that's rising. And so, yes, you can have a situation where lots of the components of CPI are in fact transitory. You're going to get massive spikes, and as supply catches up with demand, you'll obviously you'll get less and less of that price pressure. But two things are important. One, I don't see the price changes going down. I don't once those prices go up, I don't think we're ever going to see them come off. So those prices are here to stay. Prices are sticky, sort of on the up, going up. And the other thing is, I think that's different. I think we haven't really seen The service sector in many parts of the world and the US and Canada still haven't quite, come back. And you're seeing those prices are also going to rise. They're going to catch up to the goods. Goods are more, subject to supply chain issues, whereas services, they're lagging obviously. And then you got the wage growth that we haven't even felt, and we're seeing everywhere.
I want to get into that wage growth because there's actually an important topic here. But quickly for Canadians that are listening to this, because I've kind of ragged on the Canadian CPI and particularly the housing and shelter component, because obviously I work in the industry, and so I kind of see what's happening in the housing market from a feet on the ground perspective in terms of how much turnover rents are increasing and how much home price resale values are going up. That the CPI housing shelter component, it doesn't seem to reflect reality. Do you have any comments? Are you able to explain to listeners? Because I think the US, in terms of how they quantify shelter, it's that, what is that? It's the owner's rent equivalent. What is it? What do they do in Canada? I think they quantify it a little bit differently. I think they base it off surveys, if I'm not mistaken.
So that's for me, right? So I think, I might get this wrong, but I think basically there's different components. Shelter is not just the owner equivalent rent. It's also this money and the amount of, the goods and services you will spend to operate your home. And so, for example, that on that part of, the ledger, you actually are seeing very acute, supply chain specific jumps, right? So if you want to buy paint or, pay for someone to come and fix the siding on your house, those kinds of things are obviously very expensive. And we've had, and as a function of the labor market, issues, et cetera. But then there's also the very, very large component, which is the owner equivalent rent, which is in part reflecting a survey. And the survey is due to how much you could rent your property, I think is something like that. And it's also a function of interest rates. So for example, if mortgage rates fall, that's part of your kind of your math with respect to owner equivalent rent. Either way, you're having a very, very large, however you slice it. And even if I got all that wrong, which I probably nailed most of it, the reality is it's a very, very large component of your CPI basket and your core CPI basket, and its contribution is rising steadily. And I think that's sort of the reality of the situation. We're only just seeing, in my view, that. And in the US, for example, I know it's a function of the fact that the rental vacancies are really, really low, and months supply of housing is really low. And Steve, you can speak to rental vacancies in Canada, because I'm curious actually on your view on that.
Yeah, well, I was going to say, Keith, the rental market's definitely gotten a lot tighter. We are seeing rents. So it's interesting because CMHC, for example, I think that they are sort of like the lead on rental data. So when you're looking at rental price increases, they're basically what it is CMHC actually surveys apartment owners, basically, right? So they go to apartment owners and say, hey, what's your average rent roll? The problem is you have people that have been living in these apartments for 10 plus years that haven't had any sort of rental turnovers and aren't facing market rents. So that's one of the issues. And number two is what we've seen during the pandemic is everyone's been upsizing to a house or more space. So people are leaving the city. They're going and either they're buying a single family house in the suburbs or they're renting a single family house in the suburbs. If you've been trying to rent a single family house in the suburbs, the rents are up 25, 30%. If you're trying to rent now a condo in downtown Vancouver, you're getting a 10% discount. But that won't really get picked up by CMHC's rental surveys because they aren't calling individual homeowners and saying, hey, we heard you had a house for rent. How much did you rent it out for? They're not doing that. So that doesn't really get picked up. So those rental numbers are kind of, again, misleading. But Keith, to get you back in the show here, the cost of maintaining your mansion there must be getting pretty expensive. Any comments?
Yeah, life is good in the mansion. It's but a couple interesting things on inflation for everyone. So from two perspectives, we're seeing prints now 5-6%. As we talked about before, there are very few items that everyone is consuming on a regular basis that has only increased 5 or 6%. So whether it's beef or chicken, or you're filling your car, or you're heating oil, like everything is going up. And this is a very big concern. It is affecting everyone. Remember, though, this is taking discretionary money away from people for spending. So we'll talk about that effect in a second. But let's not forget about the poor central bankers out there, guys. They're struggling right now. We should feel some, if not sympathy, some empathy for these guys. Because remember, their target is they arbitrarily chose a 2%. That's where they want to be for the level. And they had a real hard time just trying to either maintain that, or over in Europe, for example, I mean, they were sub-zero for a long time. And now all of a sudden it's shooting up there. Like it's twice their target level, maybe 2.5 times. And they don't know what to do right now. So that's why they're using this phase that, hey, it's transitory. A year from now, you'll be back to flat or even, but we're still up, 10% from 2 years before that. It is kind of tough out there for those guys. So I think we need to be mindful of that, because I think they have feelings as well. They have feelings, Steve, these guys.
Yeah.
So we gotta.
Yeah, sorry to interrupt you, Keith. I only bring this up just because I had this question actually a couple of times on Twitter, asking about inflation, and I was trying to explain the rate of change versus the overall sort of price level. And so, because they were saying, 2% inflation is transitory. So I was trying to explain this to a couple of people, but basically the rate of change, as Keith is just kind of mentioning, the rate of change is basically year-over-year growth. So if you take, October of this year and compare it to the price levels of October of last year, prices are up, 5-6%. Those prices never come down. It's just next year in October 2022, when we compare them against October 2021, the growth might only be 2 or 3%. So the rate of change is decelerating or slowing, but the overall price level continues to go up. So I think that's important for people to understand. When central bankers say inflation is transitory, they don't mean that the prices are going to come down. They just mean the rate of change is going to slow back to around 2% where they want it to be.
That's a really good point, Steve. And just to add to that, I think, our job here not only is to have fun, is to talk about Canadian equity markets and Canadian macro, but also to sort of inform. Another point of that transitory thing is you nailed that bit. But I think it's also about the language. It's also about what causes that acceleration, and then what caused the deceleration. And so there are things that even someone like me, who's been fighting against this transitory narrative for months, not years now, would concede that there surely are transitory. For example, shipping rates are not going to be $45,000 a day forever, right? They used to be $8,000 a day to rent a handy sized boat or a Panamax or whatever. Now they're 45. Eventually they'll come back down. So there's also that element I think is really, really important.
Keith, you should start renting out your boat. Your yacht.
Well, I'm embarrassed to say, I'm the son of a fisherman, but I don't have sea legs, so
you shouldn't be embarrassed about that.
yeah, it's one of those
honest
things.
Job.
Yeah, it is. It's hard work. As a hockey player, he's a good hockey player there. Newfoundland guy used to play for the Sharks a few years ago. Ryan Clough, that's his name, if you remember him from hockey days.
He's a good player.
And absolutely great kid. And he had a great quote there a few years ago. He was being interviewed after a game, and the guy interviewed him said, "Well, you really worked hard tonight. It was really hard work, you guys. I could see it out there on the ice." And this guy Chloe, he looks at me and says, "That's not hard work. Hard work is pulling crab pots at 4 a.m. That's hard work." So that's some Canadian stuff. But one thing, like speaking like at the personal level, for Canadians, what is not happening and what is creating a lot of frustration is that wage growth, people's salaries, bonuses, compensation, it's just not increasing. So I know we're going to see some strikes coming up and things like that are happening. But when you don't mind prices are going up as long as your compensation is going up to match it. But that's what's causing all the stress here right now today. And it's kind of interesting. I saw this report yesterday I was reading. It was US focused, but I'm sure it carries over as well. So effectively, for this labor force survey, 4% of the labor force have left they've stopped working because they've made enough money in cryptocurrencies where they feel they don't have to work anymore. And what's also interesting is that the same number, another 4% roughly of older people who are not in that market, they've just been in equity markets and bond markets, you name it. They've also retired early over the last year because they've made more than enough in their investment portfolios where they consider, hey, they can leave. So the net is about 12 million less workers in the US. So whatever that equivalent will be in Canada, because, you know, there's a lot of crossover. So when we look at all, you know, the help wanted signs out there, whichever space you're looking at, and people say, oh, they can't find workers anywhere. A lot of people have just left the workforce because they've had some successful investments in their portfolio. So the other side of that, and we'll talk about that with the deflation conversation coming up now in a minute, the question everyone needs to ask is, what happens if that success turns into failure? In other words, what happens if we get a correction in equity markets? What happens if the correction is in the bond market? What if crypto markets had a big correction or something like that? And if things don't go linear, most investors and, you know, average people, they think whatever happened last week, last year will continue for the next 12, 15 months. That is not the case with financial markets. They are very volatile. And because of all the different policies that have now been implemented around the world by central banks and governments, it's actually increasing the opportunity for this to happen. So we could be in a situation, whether it's early next year, the middle of next year, maybe as soon as January, who knows? But if we get a large correction in financial markets, all of a sudden you get a loss of wealth on paper. So people feel less wealthy, they will spend less. People will have to return to the market again. So it does create an opportunity to get a bit of a balance here coming out on the other side. So it is something to think about as well.
I'd love to jump into that because I think that's a good segue. So first and foremost, we're talking about the deflationary side, because a lot of the pushback that I get, again, this whole show is really just about, you know, explaining sort of, you know, economics and financial markets to Canadians, because the biggest one that I always get is, you know, obviously everybody talks about housing because it's probably Canadians' largest, you know, piece of their net worth. They say, oh, you know, interest rates, let the central banks should hike interest rates because inflation is hot and Canadians have borrowed so much money and they took on debt and they should be penalized for over leveraging themselves. So we should just raise interest rates, you know, tank the housing market. That will bring some affordability for the younger generation, and we'll all be good. And I think what I always try to stress and emphasize is something that Keith just mentioned, is that when your net worth takes a hit, at least on paper. So when 69% of Canadians own housing, if national house prices drop, let's just say 25%, consumer spending goes along with that. So there's something called like the wealth effect, where as you become and feel wealthier, you know, your house goes up $100,000 and you tap that equity and go buy a boat or go on a vacation, you feel wealthier, you just go and spend money. When your net worth gets cut by 20-25%, people start to rein in spending. And Rich, correct me if I'm wrong, but I think consumer spending as a percentage of GDP is about 65%.
In Canada, yeah, it's roughly there. In US, it's higher. In Europe, it's probably a bit lower.
Yeah, exactly. And as Ray Dalio put it, you know, one person's spending is another person's income, basically, right? So if spending starts to slow, that's someone else's income, and that just kind of you result in my opinion, there would be job layoffs and what. Keith, correct me if I'm wrong, but you know, I think that's my message, anyways.
Yeah, I mean, just to add, like one comment though, you know, when people say consumer spending makes up, what number you just said? 65%?
65.
Yeah, it's like 60. It's in the mid 60s in Canada, and it's like 75 plus in the US. It's, I mean, so that's implying a lot of, you know, discretionary spending, but just for people to know, healthcare is included in that. Yeah,
and that is sticky. So the number isn't actually that high. Maybe it's low 50s, I'm guessing. something along those lines. And like with Dalio, with one person's spending, another person's income, it's also the same on the asset side. So, if we do get permanent losses in the bond market, which I think there's a high probability that does happen, and that's another person's asset that gets hit. But let's just jump over to the deflation conversation.
I'm ready.
A lot of people think that's crazy. I can see the young guys there laughing and grinning right now. And yeah, that's Rich and Steve. Yeah. Steve in his Hawaiian mansion there right now. Just
setting all my cryptos over here.
Yeah. I see them stacked up on the wall there. That's pretty good. However, and again, some people talk about, hey, we have inflation right now. It's the same as what happened in the 70s and so forth. When you talk about Germany in the early part of the century, and every period there's some similar characteristics, but also they're extremely different. So, for example, the whole German story, the reason they were printing money, like paper all the time, was because they lost access to debt markets. Inflation wasn't created because they decided to print money. They created money because they didn't have any foreign money coming in. So that's one part of it. And then you look at the whole, what happened in the 70s, of course. So you think about just simply supply versus demand. So in the 70s, inflation was driven by demand. Demand was going up. Supply was basically flat. There was no supply shocks to the global economy back then. What's happening today is the opposite. Prices are going up because we have a supply shock to the system. Demand is roughly the same. So, but both outcomes give you higher prices. So then we come back to, okay, what could cause demand to come off in this environment that we have today? And that's when we go back to financial markets. So if you look at today's environment relative to, say, the 70s or any other period, we have the most debt outstanding compared to any other moment in history. So it's same with Canadians, the Americans, Europeans, Japanese, and you name it. No one else has come close to this level before. It's taken increasingly more debt to produce the exact same amount of economic growth. So as an example, just say it took $1 of debt to create 10 cents of growth, 10 years ago. These are just made up numbers, by the way. Now it's taken $10 of debt to increase, to maintain that same 10 cents in growth. It's just causing, we need more debt just to continue with the same growth we have going on here right now. Most of that growth, though, has come from the government sector. So you talked earlier about, a multiplier. You mentioned that earlier, Steve. And if you think of the world as having private capital and public capital, with private capital being the three of us and companies, households, the private sector is governments. Governments are always less effective and efficient with deploying their capital. So what's happening today is, with this multiplier, we're using the velocity of money for the US data is pretty easy to get or elsewhere. It continues to scream lower. And it's because it's taking more debt to produce less income. And at the same time, it's just becoming highly ineffective. So the probability of an accident taking place in debt markets right now, it continues to increase. And if that should happen, you go back to the whole Dalio comment that you made, is that we're going to have permanent losses in financial markets, specifically the bond markets. We'll have a negative wealth effect in other financial markets. And that's going to cause people's and households and government spending to come down as well. So again, we have this inflationary environment right now, but I'm just telling people that don't take your eye off the ball here, because this could happen very quickly. And then we'll be credible a year from now, we're having, the Loonie Hour episode number 40. And now everyone's talking about deflation again. Three of us are saying, but wait, we might have inflation a year after. So again, it's just to keep everyone honest here with the potential setup that we have, because it is pretty big, especially in the bond market.
So Keith, just to sorry to interrupt there. Just look at Lacey Hunt's recent piece here. So you talked about the diminishing returns from debt. So every dollar of debt that's produced in the US, for example, today anyways, produces 25 cents of GDP every dollar. It used to be 62 cents back in the 1800s. And in the mid 1940s, it was about 59 cents. So we're down to about 25 cents. So basically, every dollar continues to produce less economic growth, which Lacey Hunt refers to as the marginal production of debt, or the marginal return of basically new debt that's created. So, and Japan, I think, is at, obviously is more indebted than the US. I think they're at about 15 cents right now. So it's kind of the hole we're going down in Canada's in that same
boat. Can I contextualize why that might be true? And I think it's really important to all the socialists out there who will graciously lend us their ear during this podcast. I think it's not all government spending was created equal. I think this is the problem and that we're sort of dealing with. And this is one of the issues I sort of have with massive government program. If governments told me that they were going to spend all my tax dollars building roads and hospitals, grossed fixed capital formation, e.g. investment, e.g. CapEx, building ports and rails and nuclear power plants and roads and bridges, I think number one, more Canadians probably be happier accepting higher tax rates. But also, I think that you'd have a situation where at least you have something to show for your money. And I think that the problem I think we're seeing, and I'm happy to, and what's really important is that overall government spending on CapEx has shrunk massively from the times. Obviously, you can't compare with the 40s when they're building, nuclear silos and submarine hangars and et cetera, et cetera. Fine. But, government spending on the spending that's come over the last, let's say 10, 15 years has been largely focused on consumption. And that's I think a really, really important contributor to weakening productivity growth and trying to and the COVID was the classic example of that, right? It was literally money, and it was money to pay for just short-term consumption, and it tacked on 20-30% debt to GDP for Canada. I don't know what it is for other countries, but I think that's a really important distinction: how and where that money is spent, not necessarily that it is spent.
Just to add to that, one important point, and I know we've talked about this before as well, and we've talked and written about it here at IceCap. So we know now, maybe some Canadians aren't aware of it, but the amount of money spent on the debt burden or interest burden out of Ottawa, it's the same amount that's being spent on education and healthcare. It's not. So you take those three pools of money for healthcare, education, and debt burden. This was before the pandemic. So this was back in, I think it's 17 or 18 numbers. Again, every dollar that's coming in tax revenue to Ottawa, increasingly more and more of it is just going to service the debt, which comes back, to the guys at the Bank of Canada, because again, they're in a hard spot, guys. We got to show them some empathy. If they try to trigger higher rates, it's really going to create a struggle for Ottawa as well as the provinces and how they can allocate their tax revenues. And then we'll see Rich get even more passionate about his view towards government spending that's coming up. But again, circling the peg, everything is linked together here. It's going to be real tough for governments if rates go higher, because again, we have all this debt, and they're not going to be able to make efficient capital investments at all. It really just come down to day-to-day spending, because I'm sure they'll have increases for their wages and salaries too. So everyone wants to get paid.
Just to summarize, did you say so? The government, the Canadian government, the Trudeau government, their interest payments are equivalent to the amount of spending on, what'd you say, healthcare, education? What was the other one?
You look at three pods. So healthcare is one, education is another, and then they call it the interest burden. So the amount that they have to allocate to the debt outstanding. So that would be even more now, because now we're post the pandemic. Our deficits have shot up from. I bet you about 8 or 9 years ago, we were probably close to a balanced budget here in Canada, maybe 2 or 3 billion running a deficit. We're going to be 40 billion plus this year, and they want to grow this even more. So,
but that's always the running joke that I make to people, because they come back and they think, Steve says interest rates can't go up. He must be long 8 pre-sale condos and, is an over-levered fool. It's certainly not the case. But anyways, I always make the joke that I'm pretty confident my balance sheet personally is better than the federal government's balance sheet. So if they want to start hiking interest rates, again, as you pointed out, it's the amount of this deficit spending and the interest payments on that. Like the Bank of Canada really is in a tough spot. Because what are they going to do? I mean, Rich, we pointed this out, I think, in one of your charts there, but was it 87% roughly of the federal deficit has been financed by the Bank of Canada since 2019. So it's like they're kind of holding hands, singing Kumbaya. I mean, the Bank of Canada and the federal government are one and the same, essentially.
Well, so I'm going to jump in here. So first of all, I think the veneer of independence, I think we can finally put that to bed. Central banks are not independent. It's not clear that they were ever independent, but I think now it's very obvious that they're not. That's the first thing. The other thing is, I think, really important to say is, in some ways, Keith said, for every asset, there's somebody on the other side of the ledger, and there's liability, and vice versa, right? So if Canada's liabilities are assets held by certain people, e.g. bondholders. And in a way, yeah, Canada's in trouble. But I think we need to circle back to what Keith said, which is, if I owe you $1, it's my problem. If I owe you $100 million, it's your problem. And I think, one of the topics we wanted to discuss on this week was financial repression. And I think for me it's this issue of like, how does this debt ever really get paid back? And Keith thinks they're not going to get paid back at all. And I agree. It relates to the inflation just being above that interest rate in perpetuity. And it's how it happened 1946 to 1960. There's lots of really smart people done a lot of work on this. They had decent growth, fine, sure. But really the key thing was governments were able to basically just maintain an inflation rate far, far above their borrowing costs through central bank intervention and central bank manipulation of that long end of the curve. And as a function of that, they were able to reduce their debt holdings in nominal terms significantly. Who lost? Bondholders. And I think that's so for me that's my playbook going forward. You have this inflation that's like not is transitory, sure, but it will stay higher for longer. You have central bankers that are not independent. They understand exactly what you said, which is, Keith, which is an increasingly like a non-trivial sum of your revenue, tax revenue, is used to spend on paying interest payments. And so the only way you can really, really get out of that is if you deflate your debt. And how do you deflate your debt? You just run this inflation at a much, much higher than let's say should be. However, I mean, you can't do that. There's an issue. And then it brings us back to the deflation conversation, which we'll maybe touch on later. But there are risks that are associated with that, whether it's housing, whether it's equity market blowups that you get as a result of that. So I don't know how you guys feel about that financial repression view, but.
So, yeah, I mean, I was chatting with Lynn Alden about this yesterday on Twitter, but she was saying, I think she had at one point in the mid 1940s, I think she had pointed out that real rates were about negative 19% at one point. I think it didn't last very long, but still. Now, yeah, Keith, I mean, how do you play this out? I mean, as like a bondholder, I mean, I know that you're pretty bullish, like long volatility, right? Which is essentially, betting on, I know you can't speak on specific investments here, but basically betting on volatility in financial markets and housing, that there's going to be a period of distress.
Or another way, you're betting on bad things happening. And
right.
So the great thing with volatility is that when it does happen, it happens very quickly, and it's a burst. It doesn't last very long. And then you get these long periods of complacency. People are lulled asleep, and you can never have risk again. Risk never exists. And that's what we're experiencing right now. So in equity markets, sovereign debt markets, credit markets like corporate debt, crypto, for example, like no one's losing money, right? So you don't have to worry about that stuff. So again, once we get a pretty big correction here in financial markets, and it will happen, guys. And anyone that says, hey, it's never going to happen, that's just being naive. That's what markets do. That is going to, first of all, it's going to give central banks cover not to raise rates. Because remember, we talked a while ago, I think it was the lads over at
CIBC.
What's the CIBC?
Yeah, 200 basis points over 2 years.
No, Scotiabank. Yeah.
Scotiabank.
Yeah. At 8 hikes.
Actually, CIBC came out this week calling for 6 hikes. Ironically, sorry to interrupt here. CIBC, Benjamin Tal came out and said there will be 6 rate hikes from the BOC between now and I think the end of 2022 or 23. Yeah. Anyways, but I said it's kind of ironic because if you look at CIBC's mortgage lending, it's the highest it's ever been. Their mortgage lending growth is higher than it was pre-2017 mortgage stress test, when they actually got in a lot of hot water from OSFI, the banking regulator, for some unfavorable lending conditions that they were creating. But anyways, that's neither here nor there. Keith, continue.
Yeah, well, I mean, 2 things with that. First of all, people have to understand a bank's mortgage origination department, that is, they run a P&L, profit and loss, and they don't care what the future may call for. Hey, if the market is hot, they're going to run it. Like that's what anybody would do, right? That's what capitalism is all about. And as well, people may not realize this, but the economics departments or teams or units at the big banks, they do not run a P&L. So they are not running a profit and loss. It's a cost entity for every bank. They have the salaries and computers and data fees, stuff like that. And that's it. They don't generate direct revenue for the bank. So you're always going to see disconnects between what the economist might say, or, with a lot of politicians these days, don't do as I say, not as what I do, I think is the term that they use.
How dare you, Keith?
How dare you, Rich? Yeah. But anyway, so that's sort of one thing with the banks. But again, like all of these estimates by economists for rate hikes coming up, it is all based on having a 0 or extremely low probability of some kind of economic or financial event. And should that happen, you're going to see a lot of these, numbers, and they're going to, run them back again. So that's what we have coming up. But the other thing as well, though, I mean, we're going to see credit spreads start to rise. And so forth. That's the mortgage market, basically. So you can have a situation where Government of Canada bond yields stay where they are, they stay flat, but banks are all of a sudden, again, these guys are running profit and loss books. Like, they're not dumb. Bankers are incredibly smart, the guys that are running them. And they're going to say, you know what, we have a higher probability of taking a loss in this market. So we're going to actually increase what we're charging for mortgages, say for the 5-year term or something like that. And they'll come up with a reason for it. So all of a sudden then, it takes more of your income to service that debt. But, that's where we are on that side.
I actually think this, maybe, I don't know if this call this a prediction, but I think that the bond market's probably going to do the Bank of Canada's job, i.e., if you look at where 5-year fixed mortgages are now, I think they just went up again this week. So RBC, for example, that's sort of gold standard here. They're advertising on a 5-year mortgage now at about 2.9%. So if you remember during the pandemic lows, you can get a 5-year fixed around 1.6. So now we're at 2.9. I think once he's hit 3%, I think the housing market's going to slow down materially. And that maybe will provide some air cover for the Bank of Canada to sort of get away with, hey, okay, all of a sudden the housing market's slowing down. Maybe this inflation narrative starts to ease. And
yeah. I mean, so let's now we can sort of circle things up here, because one thing we didn't talk about yet was the financial market reaction to yesterday's American inflation data, and then we have this other shift happening in all bond markets here in Canada as well. So let's talk about the bond market first, because that does directly affect the housing market, which affects Canadians and whether our houses are worth 8 figures these days or not.
Yeah. And again,
okay.
the most.
Thanks for the laugh on that one. Okay.
Your house is already in the 8 figures.
I'm crying, man. Keith.
Yeah, it's 8 figures now. But what people may not realize, so in the bond market, you can have an overnight bond. That's basically the Bank of Canada rate you're looking at. And then you have long-term bonds that will mature, say, 10 years, 20, 30 years from now. If you link up the market interest rate for all the bonds in between, you create this graph, and we call it the yield curve. And usually longer-term interest rates are higher than short-term interest rates. That's just the way it works out. What's been happening over the last couple of weeks is that this range or spread between short-term rates and long-term rates is getting tighter and tighter. So long-term rates are coming down, which means investors, they want to buy longer-term bonds. And that is usually an indicator or a signal that, hey, economic growth may not be quite as strong as what everyone is expecting. So when you get this flattening of the yield curve, that's what we would call it in our world, that should take notice. Just say, hey, this is of interest right now. So, we're talking about, hey, maybe rates can do the Fed's job for them or the Bank of Canada's job for them. We're probably on pace to have close to 1% GDP growth, I think, in Q1 coming up next year. I think that's what we're looking at. Maybe for Q4 in the US. We're getting slower growth. That could, give the central bank some cover here.
Do you want to explain that? Maybe sort of dumb it down for the listener here, but in terms of you get this again, your yield curve usually slopes, up and to the right. So it's kind of like a steep curve, right? Because the idea essentially is, you're tying your money. If you're tying your money up for like a longer duration, you would typically expect to have a higher return, right? You want to be compensated for that sort of. Now what happens?
Known as a term premium.
Term premium, exactly. And Keith is explaining that, okay, you get this yield curve flattening, which means you're not really getting paid additional for tying your money up for longer term. And then Keith, we get into the yield curve inversion, which historically has signaled a recession. So I know we're not there yet, but I'm sure that people will start to Google that in the very near future.
Yeah,
I don't know if you want to explain the trigger there.
Yeah, for the best way to. Yeah, of course, the best way to think about it, if I lend money to Rich for 1 year, and then I'm lending money to UC for 30 years, I know that I have a higher probability of getting paid back by Rich in 1 year than you paying me back in 30 years. Because, a lot of things can happen in 30 years. And the bond market is always worried about bad things that are happening. So for that reason, I'm going to want Steve to pay me a higher interest rate on the bond that he just sold me, compared to the one that I'm doing here with Rich. When the economy begins to slow down, all of a sudden investors, they want to lock in a return. So the longer term bond, they're going to get it. So they want to bid up that bond. So the price goes up and the yield comes down on that bond. Meanwhile, central banks have just been, running through, their pressers over the last couple of weeks. And they're all saying, hey, we're going to raise rates. We're going to raise rates. So that's causing market short-term rates to go up. So again, so you got short-term rates are going up, long-term rates are coming down. And that's what's causing this sort of flattening of the yield curve. And for listeners to know, the best environment in the bond market that indicates a strong, healthy economy is the opposite. So you're getting a sharp increase in the yield curve, which means people are selling their bonds and they want to buy growth assets. So they're not afraid of equities. They're not afraid of commodities. No one's afraid of crypto, so that doesn't come into play here. But again, it's all about a fear. It's a fear of losing money. And right now, things are stacking up here that there's a bit of fear in the market, which also ties into the market reaction from yesterday. So when the CPI number came out for the Americans, that was one of the biggest sell-off days I've seen in currency markets over the last couple of years. So you go right back to the March of 2020 pandemic, during the darkest days. So, but the way I work out my trade screen here for portfolios, you have the US dollars on top and then every other currency underneath. And on a typical day, you can see, commodity sensitive currencies are doing, they're going the same direction. Emerging market currencies are in their direction. Euro, yen are doing something different. After yesterday's CPI data, there was a massive sell-off in the bond world, which then got reflected in the currency world as well. So all of a sudden, if you get a surge in US dollars, which we had yesterday, so as an example, most currencies were down about 1%, to the US dollar. Emerging market currencies were down more. The South African rand was about 2.5%. Like, this is a full-on flight to quality. So you're running away from risk, running to safety. So another way to sort of, reconcile, or for the Americans to sort out their inflation problem, is to create a surging US dollar. So remember, they don't care about the Canadians or the Japanese or Europeans or anyone else. They care about their own economy. If you get a stronger US dollar, and it happens very quickly and then stays steady at that level, that's going to reduce inflation in the US. It's going to hurt anyone else outside that are paying for commodities, which are priced in dollars, things like that. But again, we don't need to, have this, singular view that the only way for the central banks to combat inflation is to raise rates or, to pull back on QE or something like that. Again, don't be dismissive about another aspect, which is the currency world. So again, yesterday was an enormous day in markets, and just a reminder that, hey, when bad things happen, money gushes into the dollar, and it gushes out of everything else. This was a good day. It was a really great day for, someone who's really interested in financial markets and how they move.
I think on the deflation camp too. I mean, they could talk about what's happening in China, and certainly, Rich, I mean, maybe you can comment on the role that they have in terms of, commodity exposure, right? Like second largest world economy. I
think they're the largest. They're the largest world economy on PPP terms now. I think that happened in 2015. Just for the record.
So, how does that play? It seems like Xi's trying to do this sort of, someone called it this controlled explosion in terms of, trying to slowly rein in their credit binge in China and slowly trying to sort of, rein in property market, et cetera, right? I mean,
I think so. I mean, I might have to disagree with you there a little bit, Steve, because I think what's happening with the Evergrande and all that stuff is a function of the property market actions and the credit market, like reining in the credit market that we started seeing actually 2 years ago. And so I think that, and from what I'm seeing is that you're actually seeing the PBOC being actually relatively dovish, right? They printed on 1 trillion yuan just a couple of weeks ago. You're starting to see M2 start to creep up a little bit. We're at the one of the things I like to look at is like something called the credit impulse. I think people put way too much stock into it, but at least it's something worth keeping an eye on. And that's the second derivative basically of the credit moves in China relative to GDP. And you can see that that's actually starting to bottom out. And you can make the case that for a long time, China's policy was actually way too tight. And now they're actually going to start loosening it. I think it relates to what you mentioned actually a couple of weeks ago, or maybe last week, but the zero COVID policy in China, to me, is just, it's completely unsustainable. It's not, you're not connected to reality, and it's affecting the rest of the world, and the rest of the world's affecting China, right? We're all sort of interconnected, to quote my preschool teacher. And I think that the reason why I think they have to sort of let up on this is because of the worries about deflationary fears. Like, what could cause deflation? I mean, Keith talked a lot about asset corrections, and you've talked about wealth effects causing deflation. Well, I mean, continued supply chain disruptions could cause deflation. I mean, you just can't do this in perpetuity. I read, the US ISM came out this last week or late last week or early this week. It was the highest. Oh, sorry. The US ISM is the Institute for Supply Management, and they produce a purchasing managers index. They do it for manufacturing sector, and they do it for non-manufacturing services. The manufacturing data is monthly, and it started in 1955, and it's a diffusion index. So they ask, hundreds and hundreds and hundreds of purchasing managers about their inventory, their backlogs, their demand, their business activity, employment, pricing, a bunch of stuff. And you say, Rich, how could surveys be so useful in predicting the economy? Number one, it just is empirically. It just has done an excellent job. Number two, these people have been doing it for a long, long time. They know exactly what they're doing. And so by watching this number, you can sort of get a bead on what earnings are going to do, what GDP growth might do, how people are feeling. Of course, it doesn't always work perfectly. Nothing works perfectly, but it's a very, very important and it's a very strong and robust indicator of economic activity and health. But the reason I touched on that is because if you look at, we're thinking about deflation. I think one of the really important things that we're sort of we just assume it's all going to work out. We're quite complacent, as to use Keith's, term du jour, on the supply constraints. And this relates to China, right? So you have, back to the ISM for services for the US, it was the highest ever. Now this series only starts in 1998, I think. So it's not as, it doesn't have the same history as the manufacturing series, but it's the highest ever. I think it was 64 something. But what I do in my job at Acorn was we go and we dig a little deeper. And if you read the actual report, although, you had a really, really strong, although demand for services sort of pushed up, the aggregate of the indicator, the aggregate sort of diffusion, there's just every single service sector, there's like 10 or 11 or 12 of them, is worried about supply. And it's affecting, supply is not just, its supply basically is affecting their profitability, and importantly, it's affecting their outlook. And if it affects their outlook, it's going to affect their investment decisions and their employment decisions. And then you eventually get sort of kind of a very negative spiral that could happen. And I think that that's one of the real things that, talk about market complacency. I think there's way too much complacency on the supply chain. I mean, inventories across the board are way, way, way down. If you look at Germany as an example, it's an export-oriented economy. Why is the rest of Europe employment's back to near peak, right? France is back to peak. Italy's doing really well. Spain's doing really okay too. But Germany's employment is still way down. Why? Because they export so many cars. It's such an important part of the thing. And think about all the the tertiary, like the interconnected sort of kind of indirect industries that are affected by that. And so I think that, one of the things that I think is really quite deflationary is this supply chain thing. If it doesn't get unlocked, if central bank if governments continue to blow out these deficits and artificially boost demand, and there's no kind of snapback from supply or unlocking the supply, I think it could be really, really bad. It's something I really think we're being way too complacent about.
Is that a situation of like high prices cure high prices as well? Like at what point, like as Keith mentioned at the beginning of the show, right? Like clearly Canadians' wages aren't keeping up with the pace of inflation. At what point did people just see, okay, I mean, we've just got news coming out here this week. This is going to be really tough news for a lot of Canadians. Cargill, which is Canada's, one of North America's largest beef producers, they account for roughly 40% of Canada's beef processing capacity. Their workers are now going on strike, right? So wages aren't able to keep up with, the cost of living. They're going on strike, and beef prices are already up, and they're probably going to go even higher now. At what point do Canadians just say, you know what, I'm not shopping for steak, and you know what, we've got Christmas coming up here in the next month. Maybe consumer spending. People say, you know what, I'm going to take a pause. I don't know.
It's so important, actually, what you said this. So last week you asked me about energy prices, and I think that's really important. And just to give some context, it was like, well, if you have energy prices spike, if you have an extremely acute increase in the most important commodity to everyone's basically life, livelihood, etc., can that spark a recession? Who knows? It can for sure. It has in the past. Who knows what's going to happen this time? But I think what's really important is this idea that you're flirting with, Steve, which is a buyer's strike, that's what it is. It's like eventually, if you don't have the increase in asset wealth from your equity portfolio or your house price portfolio, and you have increases in commodities and consumer goods and services that are 10, 15, 20, 30%, we all agree that the inflation number from Bank of Canada is far, far too low and does not reflect reality. I think that I can speak for the two of you guys when I say that. And so you have a situation where consumers just tap out. And again, that's like I don't know how you feel about this, Keith, but I think that's like a material risk. I think someone who remains quite bullish on equity markets, that's something that really worries me, right? Do people just say, I'm not going to eat beef, I'm going to eat chicken? But that cascades, right? It's like, I'm only going to go out for dinner once, not twice. I'm not going to go see a movie. We're not going to go to Maui and live the high life with Steve. We're going to go, we're going to do our vacation in PEI. And I think that you have a knock-on effect. If everyone is feeling poor at the same time, you have a situation where that inflation leads to a buyer strike. And I think something we should really keep in the front of our mind.
Yeah, absolutely. I mean, we only have so much discretionary income to spend. So if you're now, allocating more of that to your food and energy prices, and your wages are not going up, then there is less money to spend on stuff. It's kind of interesting. I saw this morning for S&P 500 for the aggregate market. Now Wall Street, they're aggressively hiking their earnings per share estimates for next year and the year after. Now, these guys are notoriously slow. They lag reality. They're what's in their mind, it really lags with what's happening with reality. So I think again, we're at this peak equity cycle where we are due for some kind of a movement coming back here. And like, and at the same time, even with commodity markets. So it was last week or week before, people were saying that, hey, oil is going to go to 100. No, it's 120. Don't discount 200. And, people have been pretty quiet about crude oil over the last couple of weeks now. Same thing with the copper market as well. And like nat gas has collapsed. But, that's a very specific market, of course, depending on, distribution and everything. Yeah. So again, inflation is the hot story right now. And, I keep circling back to, something could happen here that could really cause things to get flipped around. But just so everyone, I'm sort of taking the other side a bit more aggressively. Again, our view in that we could get a deflationary shock is if we get a financial accident of some kind. If it doesn't happen and we continue to trend along in like not huge, exponential moves upwards in the market, just gradually increasing, things can get sorted out. We'll all adapt to it. But if we do get some kind of a financial accident, which I think the probability is a lot higher than people are expecting, then yeah, we're going to see a pretty big change in mood, towards the whole inflation camp. And, just probably the last word, the part of the whole inflation story that should concern everyone, it concerns me the most because my view is extremely important. It should concern everyone else as well. Is that, again, that you're supposed to laugh. Sometimes you guys stare at me. I'm like, I don't know if they know what the boomer is talking about.
The best jokes are the ones you have to explain, Keith.
Yeah, I know. But just back to our food prices, you talked about the beef and chicken stuff. The cost of fertilizer is going through the roof, which is driven by nat gas and stuff. And if we get colder weather coming along, you're getting, again, if you think back to the Arab Spring, we think about the Arab Spring from a few years back, it's all driven by food prices going higher in that part of the world. And we get the same kind of event happening elsewhere. Again, it's going to create some stressful moments coming up here. So
it's also important to just remember that as a part of our basket, food is much, much smaller than it might be in Tunisia or Egypt or whatever, right? So when we see prices go up 30%, it's only 10% of our basket. Or when you're in Egypt and Tunisia and parts of Africa and, in poorer parts of Europe, I mean, it could be 30, 40, 50% of your basket, and so, they're right to get upset about it. But sorry, I think it's important that our listeners know that.
Because at the same time, central bank policies, they actually don't reach or benefit the people that everyone they believe is going to benefit. Right. So when they cut rates, it's not helping lower income people at all. I mean, it's helping, middle, upper class, wealthier people because they get asset price, in inflation kicking in there. So, again, when central banks, if they do start increasing interest rates again, and they can't, again, central banks cannot control inflation, especially if it's on the supply side. That's just another conversation. But we do have this potential setup where lower income households, not only in Canada, but across the US and Europe as well, they can really get this pinch here if rates start going up and food prices are going up and wages are not going up. So it's a great financial market opportunity because you want to look for displacement, being an objective investment manager. And that's where you get to really great opportunities to do some entries and exits in different markets.
I think that's a great way to end it. We've got a case of the deflation camp. I've never been more bearish on the lower middle class of Canadians, unfortunately. But we'll watch and see how this plays out. So we've got the inflation story versus now a case for some deflation. So as always, we'll be back next week for Loonie Hour, episode 6 next week. So thanks for tuning in.